The power of compounding is one of the most strong forces in investing. With compounding, earnings and returns can add up over a long length of time. Even though the effect may seem small at first, the more time that passes, the bigger the effects become. This rule applies to all kinds of trading, but it may be easiest to see on the stock market when buying stocks for dividends. By regularly putting dividends back into buying more shares, the power of compounding can boost yields over decades. This video will look at the idea of compounding and show how reinvesting stock market income is an amazing way to make money grow quickly. So before starting this video, please like this video and subscribe to this channel for our future updates. How to explain compounding? At its heart, compounding is the process of getting a return on both the money you put in the first time and any gains you got before. By getting interest or returns not only on the capital, but also on the interest or returns from before, the growth speeds up in an exponential way over time. An easy example is getting 5% interest every year. In the first year, $100 that earned 5% would be worth $105. In the second year, interest is made on $105, not just $100, so the total is $110.25. Each year, the earnings grow, which makes the effect of compounding grow and grow. This is the powerful but simple idea that makes the stock market so good over the long run. What happens when dividends add up? Even though stocks can go up in value over time, dividend income is also a big part of their long-term profits. Think about putting $10,000 into a stock that pays a 2% yearly dividend and grows by 5% each year. Dividends are reinvested each quarter to buy more than half shares. The total amount of rewards would be more than $233,000. With interest, the money would have grown to more than $1.1 million. That is more than 10 times what you put in, and it is all because of how rewards work. But unlike bonds, which pay the same amount of interest each time, stock earnings often keep going up over time. This makes the result of compounding work even better. Many safe dividend stocks raise their payouts by an average of 5 to 10% each year. To keep owners, companies try to give them a steady stream of rising income. When earnings are raised on a regular basis and automatically put back into the stock through a dividend reinvestment program, the growth is exponential. Small rises every year add up to much bigger payouts a few decades from now. As time goes on, the total gain goes up with each fractional share bought with dividends. For example, if a company grew its dividend by 5% every year for 30 years, the dividend would be more than 6 times higher by the end. As more shares are bought with each payment, the rate of compounding gets faster and faster. Compared to a set dividend or interest-bearing investment, this makes it faster to reach your financial goals. How dividends grow step by step. Over time, the power of compounding makes returns grow quickly, but there are different steps to the reinvestment process. Early stage. In the early stage, most of the initial reinvestment leads to partial shares instead of whole shares. A total number of shares slowly goes up, but this steady build-up sets the stage for growth that goes up and up and up. Mid-stage. After a few years, the higher dividends are now enough to buy full shares of the company on a regular basis. After this point, each share release brings the total number of shares a lot higher. Growth picks up in a significant way. Late stage. At this point, many more shares have been bought through investing. Even small increases in dividends cause a lot of people to buy more partial shares. Compounding makes gains go through the roof when there are more shares to start with. The total profits far outweigh the starting investment. Harnessing the force of compounding over extended periods can remarkably amplify the process of wealth accumulation. A key strategy to leverage this power is reinvesting income, which holds substantial potential for financial growth. While the concept might initially seem intricate, its clarity becomes more pronounced as time horizons stretch further. Imagine an investment as a wave that gains momentum over time. When you reinvest income such as dividends, you add the earned funds back into the initial investment. Consequently, the overall investment grows not just on the original sum, but also on the accumulated income. This creates a compounding effect, where your money generates more money, and the cycle continues to build over time. The essence of this strategy becomes increasingly evident as you extend the investment horizon. While it might be challenging to grasp the mathematical intricacies initially, the power of compounding becomes more apparent over longer periods. Each reinvestment contributes to a snowball effect, where your wealth grows exponentially, fueled by both the principal amount and the reinvested income. Dollar cost averaging plays a crucial role in making this approach accessible to most investors. DCA involves consistently investing a fixed amount of money at regular intervals, regardless of market fluctuations. This approach inherently capitalizes on the principle of buying low and selling high over time, as you automatically purchase more shares when prices are low and fewer shares when prices are high. As long as you have a steady stream of cash flow to invest, you can benefit from this technique. Examples and possible payoffs. To show how powerful income can be over the long term, here are some examples that show what could happen to a portfolio. First example. Invest $10,000 in a stock with a 2% yield and a 5% yearly growth rate. Hold for 30 years and reinvest the earnings every 3 years. It would be worth about $230,000 as a whole. Even though the average return before taxes is only 7% per year, the original investment has grown to be worth over 22 times what it was. Second example. Invest $5,000 a year for 30 years in a Standard & Poor's 500 index fund. Dividend return of 1.8% on average, growth of 6% per year. The total amount would be $150,000. The expected end value after compounding is over $1.9 million. Dividends do most of the work to turn a regular savings plan into a big nest egg. Third example. With a starting value of $100,000 and an average annual gain of 5%, quarterly dividends reinvested for 40 years, the expected value at the end is around $15 million. Shows how long holding times and compound interest can have a huge effect. These made-up examples show how average yearly returns in the high single digits can lead to gains that can change your life, thanks to the magic of compound interest at work over decades. Even small income increases each year add up to big results in the long run. With enough time, this approach could turn a small amount of money into a fortune. Taxing dividends as little as possible. Effectively managing the tax implications of dividend income is a critical aspect of optimizing the benefits of dividend growth. Taxes, if not strategically managed, can erode overall returns. Presently, the IRS can claim up to 20% of eligible dividends, redirecting these funds to the government. However, employing specific strategies can help reduce or defer tax burdens, allowing investors to retain a larger share of their dividend earnings. Investing in retirement accounts such as 401k and IRAs offers a potent avenue to mitigate tax liabilities. Contributions to these accounts are typically tax-deductible, and the invested funds grow tax-free until withdrawals are made during retirement. This deferral of taxes effectively shields dividend income from immediate taxation, enhancing the potential for compounding growth. Holding dividend-paying stocks for an extended period within taxable accounts can be advantageous. The U.S. tax code provides preferential treatment for qualified dividends held for more than 60 days during a specified holding period. This can lead to significantly lower tax rates on the earnings, thereby bolstering after-tax returns. Tax loss harvesting involves leveraging losses from other investments to offset dividend income. By strategically selling underperforming assets to generate losses, investors can counterbalance the tax liability stemming from dividend earnings. This technique can help minimize overall tax obligations. Certain investment vehicles, such as real estate investment trusts, are structured in a way that they are not subject to corporate income taxes on most of their earnings. Investing in REITs can thus provide a tax-efficient means of generating dividend income. When considering charitable contributions, donating stocks that have appreciated in value can be an effective strategy. By gifting appreciated stock instead of selling it, investors can avoid capital gains taxes while also receiving potential tax deductions for charitable donations. Constructing a portfolio with tax implications in mind is crucial. Balancing taxable and tax-advantaged accounts while considering the tax efficiency of investments within each account can help optimize overall after-tax returns. Putting profits back into buying more shares of stock over a long period of time takes advantage of the huge power of compounding returns. Even though the effect may seem small at first, it grows faster and faster the longer it has time to do its job. When companies raise their bonuses every year, this effect gets even stronger. With enough patience, the plan could use the magic of compound interest to turn small amounts of money into huge profits. By lowering taxes and keeping money going as long as possible, investors can make this method work best for building wealth that will last for generations. The stock market has shown over and over again that it rewards people who understand and use the idea of growth over a long period of time. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.